You started your own business so nobody could tell you what you're worth. Then you tried to buy a house, and suddenly a loan officer is telling you that you don't make enough money, even though your bank account tells a completely different story. Here's the problem. It's not your income, it's your tax return. Every write-off you took to lower your tax bill also lowered the income a bank sees on paper. Your accountant did their job, but that same smart move just cost you the mortgage. For decades, this was the wall. Self-employed, business owner, freelancer, contractor. If your tax returns didn't show enough net income, you didn't qualify, full stop. But there's a loan product built specifically to fix this. It's called a P&L loan, and most people have never heard of it. Let's break down what it actually is. P&L stands for profit and loss. It's the same document your bookkeeper or accountant already prepares. It lists your revenue. It lists your expenses. It shows what's left over. Simple. A P&L loan lets a lender qualify you using that profit and loss statement instead of your tax returns. Sometimes it's prepared by a licensed CPA. Sometimes it's paired with bank statements to confirm the numbers line up. But the tax return, with all its deductions, is no longer the deciding document. Why does this matter so much? Think about how a typical small business owner files taxes. Every deduction lowers taxable income. Vehicle expenses, home office, equipment depreciation, travel, meals, all legal, all smart, all designed to shrink the number the IRS sees. But traditional mortgage underwriting was built around that same shrunken number. A bank looks at your Schedule C, sees a net income of $40,000 and calculates your loan eligibility from there. Meanwhile, your business actually generated $200,000 in revenue. The bank never sees that. This is where a well-known researcher on lending disparities, Dr. Raphael Bostic, formerly of the Atlanta Federal Reserve, has pointed to a similar issue in credit access. When underwriting models rely on a narrow set of documents, they can systematically exclude people whose income doesn't fit a traditional employee mold. Self-employed borrowers are a textbook example. So how does a P&L loan actually work in practice? You provide a profit and loss statement, usually covering the last 12 to 24 months. A CPA or licensed tax preparer may need to sign off on it, confirming the numbers are accurate. Some lenders also want to see 2 to 12 months of business bank statements as a cross-check, making sure the deposits align with what the P&L claims. From there, the lender calculates your qualifying income directly from that revenue and expense picture, not your tax return, not your W-2, your actual business performance. This is different from a bank statement loan, which usually looks purely at deposits over 12 to 24 months and applies an expense ratio to estimate income. A P&L loan is often viewed as more precise because it reflects your actual bookkeeping rather than an assumption about your expenses. Who is this actually for? Freelancers? Gig workers? Real estate agents? Business owners with multiple write-offs? Consultants paid on 1099? Anyone whose real cash flow looks nothing like their tax return. Economist Emmanuel Saez, whose research at UC Berkeley has extensively documented how self-employment income reporting differs from wage income, has shown that self-employed individuals report significantly lower taxable income relative to their actual earnings compared to W-2 workers. That gap isn't fraud, it's the tax code working exactly as designed, but it creates a real problem the moment you try to borrow money using a traditional loan. Now here's the twist most people don't expect. These loans aren't some fringe, sketchy workaround. They exist because the mortgage industry acknowledged a structural blind spot. Since the years following the 2008 financial crisis, lending has tightened dramatically. Full documentation, W-2 income, and traditional debt-to-income ratios became the default standard almost everywhere. But that default standard was built around one type of borrower, the salaried employee, someone whose income is captured cleanly by a single document, a W-2. Self-employment in the United States has grown steadily for over a decade, according to data from the Bureau of Labor Statistics. Millions of people now earn income in ways that don't fit that old mold. The lending industry eventually had to respond. P&L loans, bank statement loans, and asset-based loans are part of that response. They fall under a broader category often called non-QM lending, meaning non-qualified mortgage, outside the strict government-backed guidelines of conventional loans. Non-QM doesn't mean unregulated or risky in the way it's sometimes portrayed. It means the loan doesn't fit the specific box required for Fannie Mae or Freddie Mac purchase. Lenders offering these products still verify income. They still check credit. They still assess risk. They simply use a different lens to measure that income. So what should you actually expect if you go this route? Expect to need stronger credit than a typical conventional loan requires, often in the high 600s or above. Expect a larger down payment, frequently 10 to 20%, sometimes more depending on the lender. Expect a slightly higher interest rate than a conventional W-2 documented loan, because the lender is taking on more complexity in verifying income, and expect to need reserves, meaning savings left over after closing, since these loans are designed for borrowers with strong cash flow but non-traditional paperwork. None of that makes it a bad option. It makes it a specific tool for a specific borrower. Here's the modern mirror in all of this. The economy has shifted. More people work for themselves than ever before. More people build businesses instead of collecting a single paycheck. But the systems that decide who gets to own a home were largely built for a workforce that no longer represents everyone. A P&L loan isn't a loophole. It's an acknowledgement that income can be real, provable, and strong even when it doesn't live inside a W-2. You built a business so you could define your own worth. Now there's finally a loan product willing to look at it the same way you do.